the path to financial freedom. Master money, saving, investing, and business. Lecture 15. Passive investing versus active investing. Which one is for you? Module 4. Investing like the wealthy. Investing can seem complicated with all the strategies out there, but most fall into two main categories: passive investing and active investing. Each has its own set of advantages and disadvantages, and the right one for you depends on your financial goals, risk tolerance, and how much time you want to spend managing your investments. So, let's break them down to see which one fits you best. First, let's look at passive investing. This strategy is all about buying and holding investments over the long term. With passive investing, you're not trying to time the market or make quick profits. Instead, you simply track the overall market, typically through low-cost index funds or exchange-traded funds (ETFs). You don't need to be actively involved in managing your portfolio, making it a more hands-off, stress-free approach. And because of this, passive investing usually has lower fees and more stability in the long run. It's great for investors who want a more automated way to grow their wealth without constantly worrying about short-term market movements. On the other hand, active investing is the opposite. This is where you, or a fund manager, actively buy and sell investments in an effort to beat the market. Active investors do extensive research, make quick decisions, and time their buys and sells based on trends or market news. This approach offers the potential for higher returns, but it also comes with higher risks and costs. Active investing requires a lot of time, knowledge, and attention, so it's best for those who enjoy market analysis and have the resources to manage their investments regularly. It's a strategy that demands continuous learning and adaptation to ever-changing market conditions. If you're willing to put in the effort, active investing can be highly rewarding, but it's important to be prepared for the ups and downs along the way. Did you know? Most professional fund managers fail to beat the market over the long term, even though they spend hours researching and actively trading. According to studies, over 80% of actively managed funds underperform the S&P 500 index after fees and costs are factored in. That's why many legendary investors, including Warren Buffett, recommend low-cost index funds for most people. So, let's take a look at the pros and cons of each approach. Passive investing is simple, low cost, and tends to provide stable, consistent returns over time. You don't need to spend much time managing your portfolio, which is ideal for investors looking for a long-term strategy with minimal effort. The downside? It doesn't give you the chance to outperform the market in the short term, and your returns will mirror the market's overall performance, no more, no less. Active investing, on the other hand, can lead to higher returns if you're skilled at spotting opportunities. It's exciting for those who like to be hands-on and enjoy the challenge of market analysis. However, it comes with higher fees, greater risk, and is time-consuming. The success of active investing depends heavily on the investor's ability to predict market movements and make smart choices. So, which strategy should you choose? If you prefer stability, low fees, and the ability to set it and forget it, then passive investing might be the way to go. It's a great option for people who want to build wealth steadily over time without constant monitoring. However, if you love doing research, enjoy market analysis, and are comfortable with the risks involved, active investing could be a good fit for you. Just keep in mind that it requires more time and knowledge. There's also the possibility of combining both strategies. Many successful investors use a mix of passive and active investments, depending on their financial goals and risk tolerance. By balancing your portfolio, you can diversify your investments and aim for the best of both worlds.
If you enjoyed this video, show some support by hitting like, tapping the bell, and subscribing so you never miss our latest content on financial freedom and wealth growth. Let's grow together. Your one click makes a big impact and helps us create even more for you.